Good evening. I'm John Batchelor. Larry Kudlow, my colleague and co-host of Kudlow Reports at CNBC and Kudlow Radio on the weekend. Larry, the market was up handsomely today, and I always take that as good news. You're in a good mood when it's all green. Is that positive for the market today? That despite all of this mixed doubt out there, it wants to go higher.
Well, look, the market was up good yesterday too, and in fact, commodities are rising once again. So all that went on last week looks like the bursting of a silver bubble, but doesn't mean the stock market's going to head south. And as a bull on this story, I still say very good rising profits are the backbone of the stock market, and I haven't seen any evidence yet to the contrary.
Right. Profits must translate into higher prices in the market because of the multiple. Is that a crude version of why they go higher?
Well, that's true. I always say this, John. Profits are the mother's milk of stocks.
Right.
And when profits go up, shares go up. And until and unless we see some kind of profits slide, then it's going to be okay. I mean, corrections come and go. I'm not smart enough to know the timing, but the market fundamentally looks very sound.
We welcome Paul Vigna of the Dow Jones, who reports every day live at market close or market open to the WSJ.com audience. Paul, a very good evening to you. We're bulling the market here, and we don't want to hear doubts, but right now, is a bull phase a way to describe this, or is this a recovery phase? Good evening, Paul.
Hey, John. Hey, Larry. How you guys both doing? I mean, look, Larry's right. The market, it got tripped up last week. And it probably really was something that started in the silver market and in the commodities, and it fed over into stocks. That said, I think the dynamic that's going on in the stock market right now is, you're right, corporate profits are doing well. They have recovered tremendously compared to where they were a year ago, where they were 2 years ago. Where they're going to go from here is a big question, and there's a real schism, I think. There's a real split between what's going on with corporate profits and what's going on in the real economy. I don't think the real economy is doing quite so hot. I mean, we're still getting over that first quarter GDP number, which was 1.8%. It's a low, it's positive, but it's a low number. It's not strong. We had a jobs report last week. Jobs report was good. But again, nowhere near enough jobs are being created out there, and the unemployment rate actually went up. You can argue which one you want to believe that is better, the 244,000 jobs created or the unemployment rate going up. But the real fact of the matter to me, the biggest thing to me about the employment picture is wages, and wages are not rising very strongly. They're really not keeping pace with inflation right now. And so, to me, that is a sense of that's a sign that the job market is still weak. So I think what you've got going on right now is you've got strong corporate profits, not a great economy, not a great jobs market, but what's really holding a lot of this up is the Fed's quantitative easing program, their bond buying program, and I think that's what really kind of helped turn everything around from all the turmoil last week, is the fact that the Federal Reserve, is still pumping money into the system, and they're going to be doing that through June. They're going to be, at the end of June, they're going to quit this program. I think then you're going to see what the real fundamentals are.
Well, look, these are all good points, and you've outlined the debates on Wall Street very, very nicely, Paul. I agree. Let me just say, regarding profits in the real economy, and the real economy is just not good. I mean, if you ask me, it's barely a recovery coming out of this deep recession. It's barely a recovery. In fact, most of the major indicators are still well below their peaks in 2007 and early 2008. So I agree with that. Jobs, yeah, they look a little better, but we should be printing 400,000 jobs a month, not 250,000. But I come back to the profits thing, because remember, the stock market is a global market, and these are global companies. And so their profits are derived from all around the world, where there is growth and there is demand, and they're making great money. That's a key part. The U.S. stock market, it's funny, it's the U.S. stock market. I get that. But it's really the global stock market. It's the world stock market, and it's a pretty profitable world right now.
Well, I mean, you're right. It is where the real profit growth is coming from overseas. I mean, the United States is still a bread and butter economy and a marketplace that all these companies need. But yeah, they are multinationals, and they do a lot of business overseas. What I look at the estimates for corporate earnings going through the rest of this year and through 2012, and as much as they've risen in the last 2 years, they've risen off very, very weak prior year comparisons. Those comparisons are not going to be there, and for the next year and a half, the estimates that I've seen don't have corporate profits rising much. So if corporate profits start leveling off, and if the economy isn't doing well, I don't know where stocks go from there.
Well, hang on, though. The profits may not level off. What's going to level off is the growth rate. The profits are still going to rise, and that's very important because it's the level of profits that correlates with the level of share price.
And I'm talking about the level of profits. I mean, not just the profit growth, which obviously has to slow. I mean, you can't have 30, 40, 50% profit growth every quarter, but just the actual dollar level of corporate profits. If that is not rising at at a sharp rate, which it's been, right? I don't know where stocks go.
Well, that's right.
Let's talk about QE2, because Larry advanced a week ago, Larry. If I say this incorrectly, I apologize, but the QE2 that ends at the end of June, Larry has argued, Paul, that is a way of talking about tightening because they're not going to print more money. And it is a positive step, not as much as those who want tightening now to strengthen the dollar. Do you interpret that, Paul, not as a bad moment, but as a moment for the market to stabilize and prosper because there's no more cash flow?
It could be that way. It is a moment of truth for the economy. You know, the Fed is kind of taking away a big support that it's been putting out there. The thing of it is, they did it last year and it didn't work. They stopped buying bonds, and as soon as those payments had settled, the economy started tanking again. Everybody freaked out, and by the end of the summer, Ben Bernanke was talking about QE2, the next program. I would like to think that it's going to be a positive. I want to think that Larry actually is going to be right, because if the Fed does stop buying bonds, if they stop putting that money into the economy, and the economy kind of holds its own, then yeah, it's a very good sign for the economy. It means that the recovery could be sustainable. One thing you have to keep in mind, though, is there are two questions. One is that the Fed is keeping interest rates at a very low level, and that's not going to change. And that's the traditional stimulus that they put into the economy. That's still there. The other thing is the question of what are they going to do with these bonds? Are they going to start? Are they just going to let them mature over the time? If they do that, it's slowly. It's considered tightening, but over a very slow case because they're not actually reversing what they did. They're just kind of letting it roll off.
Well, that's the second step of tightening. I mean, right. They're going to reinvest the redemption proceeds of the bonds. That keeps their balance sheet stable, and then eventually they'll stop doing that. But the thing that interests me is the power of QE2. Most of QE2 did not circulate through the economy. Most of the increase in money is on deposit at the Federal Reserve, getting 25 basis points, sort of like if you and I have spare cash and we leave it in a money market account in a bank and the bank pays us 25 basis points. That's what's really happened here. I think the potency of QE2 has been very weak so far. It may be stronger as we get out there because you've got $2.5 trillion total and $1.5 trillion or so on deposit at the banks. But I don't think we've seen much potency in Q. I mean, look, you just said the economy is going, sideways, okay? That's after QE2. What did it do? Yeah. It didn't do anything.
No, you're right. Well, you know what it really did? I mean, Larry and John, you guys both know. I mean, money is fungible. And if a bank holds money on reserve with the Fed, that frees up other money for them to spend. And where the money really went is into commodities.
I think
into the market.